Every economy has one master pedal, the interest rate. Press it down, cut rates, and borrowing gets cheaper, spending revs up. Every central bank lives by this pedal. Now imagine pressing it all the way to the floor, and nothing happens. Money is free, and the economy just sits there. John Maynard Keynes named this nightmare in 1936 the liquidity trap. Here's the machinery of it. When rates fall near zero, bonds become a terrible bet. Prices and yields move inversely. So at 1%, a 30-year bond is priced for perfection. Almost no upside left. And if yields merely rise back to 2%, it loses roughly a quarter of its value. Tiny reward, huge risk. So investors do the rational thing. They hold cash, and that's the trap. Every new rupee or dollar the central bank creates gets hoarded, not spent, not lent. Money demand becomes effectively infinite. You're not stimulating the economy anymore, you're stuffing a mattress. Keynes wrote this into the general theory while staring at the Great Depression, explaining why the ordinary playbook wasn't working. For 60 years it stayed a textbook curiosity. Economists moved on, and then Japan fell in. After its 1990 bubble burst, the Bank of Japan cut, and by 1999 hit zero, and nothing revived. Lending stayed flat, deflation crept in, growth flatlined. Japan became the laboratory of the trapped, inventing zero interest rate policy, then quantitative easing in 2001, tools no textbook had needed before. In 2008, the trap went global. The Fed hit near zero within months of the crisis. The Bank of England followed. The Eurozone reached the floor by 2014. Some banks even went negative, charging banks to park money. But there's a limit. Push depositors too far below zero and people simply hoard physical cash. The floor is real, and banks bleed all the way down. So the trapped world invented an escape kit. Forward guidance, promise loudly to stay at zero for years, and long-term rates fall today. Quantitative easing, buy bonds by the trillion, forcing investors out into riskier assets. Paul Krugman's twist, the central bank must promise to be credibly irresponsible, commit to future inflation so that even at zero, real rates fall and cash starts burning a hole in your pocket. The bluntest tool, dropping money directly on citizens, deserves its own episode, and beneath them all, one honest admission. When the money pedal fails, the government's spending pedal has to carry the economy. For investors, a trapped world has a signature: bond yields pinned low for years, growth stocks crushing value stocks, cheap discount rates flatter far future profits, property prices climbing on cheap mortgages even when the economy is weak, and quiet pain for banks, pensions, and insurers who simply cannot earn the returns their promises require. India so far has stayed out of the trap, and the reasons are instructive. Fast growth keeps the natural rate of interest well above zero. Inflation targeting keeps deflation, the trap's real accomplice, away. A young population keeps demand alive. The trap isn't an Indian problem today, but its dashboard makes a fine early warning system anywhere. Watch the real rate, watch inflation expectations, watch bank health. The deepest lesson is about the limits of power. A central bank's interest rate is not a rod. It's a rope, superb for pulling an overheating economy back, useless for pushing a frozen one forward. Knowing the difference is half of macroeconomics. If this changed how you read a rate cut, there's more where that came from.